Broadcom released some very strong earnings last week, with the big highlight being a 10-for-1 stock split. Now, this is a company that has performed phenomenally over just the last 12 months, up 96%. In fact, over the last 10 years, up more than 2,000%. So we're doing a deep dive today to understand if we should be buying before the stock split for massive future gains. We're going to take a look not just at their earnings report, which was very strong. We're also going to take a look at Morningstar, who dive a little bit deeper. They have also increased essentially their forward targets for this company. We're going to talk about how this is affecting Google, who use a lot of chips from Broadcom, meaning that this is a very bullish indicator that this stock increase has just started. And as always, we want to just briefly remind you of the market of AI as a whole, how it is going to be growing consistently over the next 10 years, with lots of room for companies like Broadcom to increase their top line as well as their share price. We're also going to discuss a little bit of some insider selling that we have seen just over the last few weeks, and also run through essentially what the institutions have been doing over the last few quarters. And I think quite importantly, we do want to pull out some slides just from their latest investor presentation, so you do understand where this company has been and where it is estimating to go over the next few years. And as always, as part of our analysis, we will be looking at their top line revenue growth, their bottom line net income, as well as a quick look at the health of this company, total cash versus total debt. Always important to understand how a company's balance sheet is looking, so don't miss that out. And very, very importantly, we want to see what is the valuation model saying for Broadcom. What is our intrinsic value? What is our acceptable buy price? Remember, we'll forecast and incorporate a margin of safety. And Wall Street themselves, what are they seeing in terms of growth over the next 12 months? And what I quite like to do with Broadcom is to essentially run through 3 different targets: low, medium and high, so you also understand where our intrinsic value is coming from and whether or not you agree, and you can also see what price you do believe this company to worth over the next 12 months at a minimum. Now, before we get into any of the actual numbers, let's take a quick look at their earnings, and we can see just on the headline they posted earnings for the second quarter on Wednesday that essentially beat analyst targets, as well as the 10-for-1 stock split that we just mentioned as well. One thing to note, this will be applicable from July the 15th, and what this means, for every one stock you have now, July the 15th, you will end up having 10 shares of Broadcom. Now, in terms of the actual numbers, well, how did they perform? What I always like to do is just see against analyst targets. 1096, higher than the analyst of 1084, so already a great sign to see. On top of that, revenue 12.49 billion, again another beat, not just on EPS but also on their revenue. Now, that is very great. What I also like to see is they have increased their forward guidance for sales, 51 billion for the full year, and what we can see, in fact, it was estimated around 50.42. Now, one thing that maybe you're not too certain or haven't heard much of with Broadcom is they do a lot of supplying for Google, and essentially, as we can see here, they work hand in hand. They partially design their own AI chip called a TPU, and this is one thing that we did highlight at the beginning of the episode. The fancy Google designed TPU AI chips have a lot of awful help from Broadcom, and essentially one of their main customers, as we can see, Alphabet. This isn't going to go anywhere in the short to medium term, so you can expect this growth on their top line to continue. And what's very interesting to note with essentially Morningstar, they do analyze companies, they have their fair values quarter on quarter. They may change these depending on the outcome of their earnings. What we can see, in fact, they have increased their eventual fair value target to $1,550. What it was initially before their earnings, $1,350, and they do consider Broadcom to have a wide moat. Now, one thing that I did just want to extract from this information from Morningstar's report is that they have highlighted in detail here how essentially management have increased their forward guidance, 51 billion for the full year, up from 50 billion, so they're expecting an additional 1 billion of revenue, and as we can see here, purely all down to AI revenue. And in terms of their sales, they expect over 11 billion in AI chip sales, up from 10 billion. So this isn't a bubble, as we can see a lot of increasing numbers on their top line, their earnings per share. And what I also want to point out for maybe those that are new to the channel, as we have discussed this before, but AI as a whole is expected to increase potentially a 1.3 trillion market by 2032. So chips will continue needing to be essentially owned or bought by different customers, whether it's Microsoft or Google in the instance of Broadcom. And also it is anticipated to grow at a CAGR, so a compounded annual growth rate of 42% over the next 10 years. So lots to like about essentially Broadcom, where this company is going. They're increasing their top line, earnings per share, as well as now their forward guidance. So historically, how have they performed? Always important to understand. And on this channel, we do typically look for around 3 to 7% growth year on year. But what we know with Broadcom, 4.3 billion on their top line in November 2014. Latest annual accounts, 35.8 billion. So a massive increase over the longer term. And graphically and visually, what I quite like to see here is that it's consistent increases over the longer term. This isn't a company that suddenly over 1 year has now increased their revenue. It is very gradual, very consistent, and that gives us a lot of faith and confidence that they will be able to continue this over the longer term, especially with AI not going anywhere at all. Now, bottom line, also something that is very important to understand. Just because a company increases their top line, we need to see, is this showing right at that bottom line? Well, 263 million reported in November 2014, 14.1 billion in October 2023, and graphically speaking, we can see some inconsistencies, it is to be said, by looking at this visually, but we can see over the longer term it is increasing, and in fact from 2020, essentially the last 4 years, we do see that growth. Something to maybe keep an eye on just to ensure the consistency, but with the revenue increasing and in fact raising their guidance, we would expect their bottom line net income to continue in that vein. Now, in terms of the health of the company, don't just look at the numbers in terms of the revenues, also understand the balance sheet. Total cash and short-term investments, 1.6 billion in November 2014. Last report, so their latest quarterly report from last week, 9.8 billion. So what we know overall, in fact, their cash position is also increasing, which is a good sign. You know, they have a lot of cash sitting there. But in reality, that number on its own doesn't mean anything. It could say 20 million, it could say 20 billion. What you always need to do is compare it to their total debt and understand a quick snapshot of the health. Now, 5.5 billion in November 2014, 74 billion as we can see in their latest quarterly report. Now, in my head, a little bit of a red flag indicator is just going off there because we can see their total debt has been increasing sharply over the last 10 years. Now, it may not be of importance to you in terms of the dividend, but the dividend safety does correlate to some of those numbers, so something that we will talk about later. But just bear in mind for now, as we have seen, their total debt has been increasing and is significantly higher, as we can see here, 74 billion. Than the cash position they have right now. Now, when we take a look and move on to their earnings estimates as well as forward looking, always great to see. And one thing I love, especially about Broadcom, the last 4 quarters, they have beaten management estimates as well as analyst targets. So that is a 4 for 4, 100% track record. And it might give you confidence moving forwards into the next quarter as to where this company is heading. What I also love to see about Broadcom, double-digit anticipated growth year on year in quarter 3, and that is expected to continue over the next 4 quarters. A great sign to note. And in fact, if they do hit their earnings per share estimate of 2025 at 59.91, the forward P at this point will be around 28.96. So lots to consider there, a lot of information for when you do your own analysis, but there is something there that you can incorporate into your investment thesis. Now, what we also like to do on this channel, look at some gradings. The first one is the valuation grade. Now, they do get an F, but do bear in mind this will compare it now, all the information, to the sector median, and as always, the sector median may not have some strong numbers on the growth and profitability as Broadcom. So in terms of Broadcom, a P on a non-GAAP basis, 36.36. As we can see, the sector median significantly lower, so it is trading at a premium of 54%. And as always, there are other metrics here if you do want to take a look, but what we can clearly see, even on a price to sales, price to book, whether you look at a trailing 12-month basis or forward looking, it is significantly higher, trading at a massive premium than others in the sector. So something to bear in mind and possibly incorporate when we do come to our essential investor margin of safety. Growth grade, will they get a B? No surprises then why they are trading at a premium. Year-on-year increase, 22%. Look at the sector median, low single digit. Revenue forward looking 21%, again forward looking, sector median mid-single digit. So these are a few factors as to why they are trading at a premium. It is up to you to justify if it deems that additional price. In terms of earnings per share, well, moving forwards over the next 3 to 5 years, 17% increase year on year. Sector median still pretty strong. You could argue that it is still very healthy. 13.88%. So that is essentially the growth metric. Now we can take a look at the profitability and they get an A+, phenomenal to see. Incredible growth margin, 74%, sector as a whole 49.5%, bottom line net income 24.1%, as we can see the sector median 2.88. So across the board, pretty much for profitability, they blow out every single company as a whole in terms of the median. And when we do take a look at cash from operations, 19 billion, with others in the sector at 93. So just to wrap this part of our analysis up, Wall Street do give this company a buy rating, pretty strong as well, 4.47 out of 5. Seeking Alpha and Quant give this a hold. Valuation aspect an F, growth a B, profitability A+. Now what is also interesting as looking as part of our analysis, how does AVGO compare to others in the industry? Taiwan Semiconductor, another very strong company, Advanced Micro Devices, Broadcom, Texas Instruments, Micron Technology. A lot of these we have reviewed even not too long ago, but as always, let us know if you want a refresher on any of these. So over the last year, AVGO, as we can see, up around 99%, and in fact, the one that does go slightly higher is MU Micron Technology. But overall, in fact, in this industry, even if you pick the worst one, Texas Instruments, you still would be up around 13%. When we expand to over the last 5 years, AVGO, as we can see, 663% up, very, very strong. In fact, the two closest would be Taiwan Semiconductors and AMD. And when you expand this over the last 10 years, in fact, AVGO up over 3,000%. AMD, though, taking the cake there at 3,800. One thing we would say, though, very strong performance over the last 10 years, no one would be complaining, but do bear in mind that past performance is not an indicator of future performance. So as always, don't expect this to happen over the next 10 years. Yes, it could be a lot better, in fact, but it could also be significantly worse. Now, a lot of people tend to ask, well, why would you invest in an individual company when you could just invest in the S&P 500? Very good question, and the only reason we would advise that is if you believe the company you're investing in will outperform the S&P over the longer term. Just look at Broadcom, up nearly 100%, with the S&P up 24% over the last year. Over the last 5 years, S&P up respectable 88%, AVGO up 663%. Over the last 10 years, doesn't even come close. In fact, the S&P is just one flat line given how strong Broadcom has been. But again, very key, just to what I said moments ago, past performance is not an indicator of the future performance. Now, very important to understand insider ownership, both buys and sells. It is sitting around 2% in totality, 92 million worth of sales by insiders over the last year. Granted, we do see some buying at around 10.45 million, but that is essentially outclassed there by a massive amount of insider selling. Just in the more recent quarter, 40 million worth of sales, Q1 29 million, Q4 48. So constant selling by insiders, but as always, we can have a quick look to see who these were. In fact, the more recent one was the director, Justine Page, on the 10th of April, sold just over 100 shares for around 145,000. The largest one was on that same day on the 10th of April by an insider for around $3.3 million. Now, whether or not this is a bearish signal, information is there. You can include it. For me personally, I wouldn't consider insider selling a bearish signal. Management sell for many, many reasons that we don't know, personal, financial. What I would say though, insider buying, if we do ever get some recent insider buying, very bullish signal. Realistically, they'll only buy if they believe the share price will go up. Institutional ownership, well, sits at 76%. We noticed 63 billion worth of sales by the institutions over the last 12 months, with a lot more buying, 251 billion over that same time period. We can see the majority of this though in Q2 of 2023. But having said that, essentially the next 3 quarters after that, we still know a lot more buying by institutions than selling. Again, Q1 of 2024, the latest data set, 13 billion buys versus 10 billion worth of sales. As always though, whether you include this or not, always do your own due diligence and don't just copy institutions, don't just copy essentially what the insiders do as well. Now, before we move on, we just want to point out we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, do click on that pinned comment below. For example, if you want to see the websites and resources we use, this article will be helpful. Or 12 undervalued dividend stocks, very high quality companies. Again, click on that pinned comment below. You can sign up, instant access, and it is completely free. So now let's jump into their latest investor presentation just from 2 days ago. And the first thing we want to point out is the growth across the board. As we can see here, FY23 net revenue 35.8 billion. As we can see, lots of growth anticipated over the next few years. In terms of the IP, the intellectual property, they have one of the broadest, is what they claim, with 23,000 patents. And they do spend quite a lot of money on investment in R&D, research and development. No surprises, especially for this industry. They talk about how they have 26 category-leading semiconductor and infrastructure software divisions. Now, what is quite nice to see in terms of their growth visually, we will cover this over the last 10 years, but let's just go through this as it is in their presentation deck. Their top line revenue has been increasing over the last 5 years, and as we saw, in fact, into FY24, they are anticipating 51 billion, so massive growth just from that previous year. If you are a regular viewer, you know we don't just want to see increases to revenue, but we also want to see increases to their margin. Now, it has increased from FY19 to FY23. Just a shame, though, it has dropped from the previous year, 75.6 to 74.7, something we will keep our eye out when we do see their latest annual accounts. Adjusted EBITDA as well, that has been increasing over the longer term. And free cash flow, very important for us. What we want from companies are increasing consistent cash flows year on year. That is definitely something they execute very well on. Again, we'll cover this, but we just want to show you in a different format that they have been increasing that dividend 35% year on year from FY16 to FY24. Absolutely phenomenal. If you had invested in this company, essentially FY16 nearly 10 years ago, you'd have got $1.94 per share that you held. Now, if you hold on to it, you'd get $21. This is probably one of the best dividend growth companies out there, so definitely do take this into serious consideration if you don't already hold it. In terms of the dividend safety score, well, 67, it does look to be safe. 808 billion, it is a mega cap company, and it was reaffirmed essentially a few months ago that the dividend safety means a dividend cut does look to be unlikely. Now, in terms of the last recession, well, no comparative data as they didn't pay a dividend, but they did have pretty much average growth, negative 12%, which is in line with the S&P. As we just discussed now, dividend growth, they had an increase of 14% just last December, 19% over the last 5 years, and a phenomenal 36% year-on-year increase to that dividend just over the last 10 years. They have also been increasing those dividends for the last 13. So let's take a look at dividend yield theory. Now, for those that are new to the channel, it does state the company is undervalued when the current yield sits above the 5-year average. We see the opposite now, so this is a sign of overvaluation, as well as the forward PE 31.8 above the 5-year average, another sign of overvaluation. And we can also see the information technology sector as a whole does sit significantly lower, 27.2. Just remember though, we don't look at any of those models in isolation. We will conclude towards the end. And in terms of the free cash flow, remember, earnings susceptible to manipulation by management through accounting. We do draw attention to the free cash flow. Also helps us to spot any potential dividend cut, and below 50% if we want to have a preference or essentially be industry specific for semiconductors. My personal preference though, below 60%. Now that does just give me faith that management can offer those double digit increases we love to see. And for Broadcom, it has been below 60% every single year, 35 anticipated over the next 12 months. Free cash flow, absolutely gorgeous. It has been increasing consistently over the longer term, is expected to increase into 2024. Honestly, this is one of the best things to see as an investor. We then move on to the sales. Now, what we do know here, it has been above that 3 to 7% year on year. And as we can see, even though the last year was 8% 2023, massive increase expected into 2024. Just purely on a trailing 12 months, it does currently sit at 22%. Now, in terms of sales, we did see this, but if you just want to look at this in a different format, one thing that I would like to see from this company are some share buyback. In fact, what we have noted is the opposite. They would have diluted your position over the last 10 years, but as always, their share price has increased significantly over 2,000%, so you probably wouldn't care about this right now. In terms of ROIC, as always, above 10%, but above 12% if you want to be industry specific. One of my favorite, essentially, metrics. Does give me faith that management are able to effectively allocate their capital. Pretty inconsistent, although the last 3 years have been very strong. Trailing 12 month does sit at 10%. Maybe something just to look at, but pretty much the other metrics have been spot on. So maybe this one you can be justified for being acceptable at that level. Operating margin, well, above 16% it is, and in fact operational efficiency has been increasing over the longer term. And just look at the free cash flow margin, absolutely beautiful. Over the last 4 years it is around that 50% level, and in fact even before that, and on a trailing 12-month basis, in the 40s. This is an absolutely gorgeous sign to see. They are an absolute free cash flow machine. In terms of net debt to EBITDA, earnings before interest, tax, depreciation, amortization correlates to, remember now, both balance sheet strength and dividend safety. Below 1.5 is what we want to see, and remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. Now, very inconsistent. Now, it has increased up to around 1.84 expected over the next 12 months, and this was one of the worries with the company that I did say to you earlier. When we did look at a quick snapshot of their health, do bear in mind with Broadcom, they do have a significant amount of total debt in comparison to their cash. Not a massive red flag just now, but something that we should keep an eye on moving forward. Jump into the valuation model, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Let's jump into the discounted cash flow model. We have the free cash flows year on year, average growth rate 48%, looking absolutely phenomenal. Now what we're looking today, 3 different growth rates. So we have gone from a low rate at 16%. Again, remember the compounded annual growth rate of AI is expected to be above 40%. And in fact, we have gone lower than the average growth rate. So based on that, with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by shares outstanding. And we can see here, we do have an undervaluation signal, but pretty much showing us a fair value, because when we do take a look at the upside, it is sitting around 3%. So if you do believe that Broadcom will grow around 16% on the free cash flow over the foreseeable future, then right now we would argue it is trading at a fair price. Now for those who say 16% is way too low, let's look at 18%. Well, that would give an intrinsic value just over $2,000. And as we can see here, that would be upside of 19%. Now again, a lot of people will say you're still too low, way too conservative. At 20%, an intrinsic value of $2,400. And as we can clearly see here, upside of 38%. Now, very subjective. This will depend on essentially what numbers you do believe will be accurate over the longer term. And as always, you can click on the pinned comment below, grab a copy of this model to get to essentially your own numbers, your own intrinsic value, as well as your own acceptable buy price. Moving forwards though, we will take the medium rate of 18% to the intrinsic value calculation. And in today's episode, the intrinsic value just comes to the DCF model at just over $2,000. Now, in terms of the current price, $1,740, we will use a margin of safety, and as always, we'll start off on 10%, and we only execute on this if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, a buy up to 1863, and then we keep going till it's near the current trading price. And pretty much in today's episode, we see a margin of safety of 15% for Broadcom with an acceptable buy around $1,760. Now, do remember this is solely based on the growth rate around 18%. So if you do grab a copy of the model, you can play with your own numbers. But essentially, we see a 15% MOS level. And in terms of Wall Street, well, over the next 12 months, they do see upside 8%. And in fact, their price target is $1,883. Now, this company is going for a 10-to-1 split as well, July the 15th. So remember, for every 1 share you do have before then, it will then turn into 10. It won't make a difference to the actual amount that you hold in terms of the value, but it's just the number of shares. As always though, let us know your thoughts in the comments below. Is Broadcom one you are looking to buy before? Do you see a lot of upside in terms of the growth rate moving forwards? Do you think it will continue to increase? Let us know your thoughts below, whether you're buying, selling, or maybe on the watch list. And as always, if you do enjoy the content and value is being provided, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.